Welcome to What's Not Priced In, a weekly investor podcast by Fat Tail Investment Research. In a world of confusion and rapid change, experts Kirill Prakapenka and Greg Canavan look behind the headlines to unveil the hidden opportunities within the Australian stock market. Now, let's dive into today's episode.
G'day everyone, Greg Canavan here solo today for the 9th episode of What's Not Priced In. I booted Kirill from the studio just for this week. I've organised a interview with fund manager Romano Sala Tenna from Katana Asset Management. I've been reading Romano's stuff on Livewire for some time, and I find that a lot of the things that he writes about I have an affinity with. So a little bit of behavioural bias this week. I'm talking to someone who I guess thinks a little bit like me. But look, we run through Romano's views on the Aussie market. He tells us why he's got 35% cash weighting to his fund, and this is a fund that's outperformed consistently over 17 years. So certainly worth listening to why he's still holding high cash levels. Spoiler alert, he thinks the Aussie market is still overvalued and the equity risk premium is not enough to compensate investors for the risk they're taking. We also talk about commodities, the energy transition, EVs, talk about his fund process of how he's generated that outperformance over time. And then we get into what Romano thinks is not priced in the market. And he runs through quite a number of different things that he thinks the market isn't pricing in right now. And then we finish off with a bit of a philosophical discussion, which I think is quite interesting if you're interested in managing your own money and dealing with the emotions of that. So I hope you enjoy it, and we will be back next week with Kirill for the discussion on valuations. I think at the end of last week's episode, we mentioned that we would do something on valuations if we got enough thumbs up and enough comments from you guys, and we certainly did get that, and we will look at running a bit of a podcast on the valuation approach that I use next week. So hope you enjoy this week's, and we'll catch up with you again soon. See ya. Romano Sanatella, thanks very much for joining us on the What's Not Priced In podcast. How you going?
Yeah, well, thanks, Greg.
So you're joining us today. We normally have my other co-host Kirill in the studio, but I thought we'd mix it up a little bit and get a fund manager on to discuss markets. You'll give us your take on what you think is not priced into markets at this stage, whether that's an opportunity or a threat. We'll get to that down the track, but I thought we could maybe start off for people who don't know you. Tell us a bit about yourself and your fund, Katana Asset Management.
Yeah, thanks, Greg. Okay, a bit about myself. So started out, did a Bachelor of Business Information Systems degree, worked for 7 years as a computer systems analyst, which I really enjoyed, but my passion was always investing. Finally made the break in stockbroking and then eventually into funds management. We set up Katana. We started the process in 2003. It took us 2 years to get all the bits and pieces in place, the license and everything else there. And there's now 4 of us that actually run the money. So there's myself and 2 other portfolio managers. Giuliano Salatena, same surname, coincidentally, Brad Shallard, and also Hendrik Bothma, our analyst here. The 3 portfolio managers have been working together in our 13th year of working together, so that shows a lot of stability, which is good, and a lot of depth as well. A lot of funds would have 1 or 2 PMs. We've got 3 PMs. And I think importantly too, we're all quite big personalities, quite egotistical, quite robust in terms of opinions, and so there's no yes men in the teams. You know, we are critically challenging each other and our views in the markets and stocks pretty much daily. I think the fact that we're in our 13th year of working together means we've probably got that balance right. We haven't shot anyone yet, and at the same time we're still able to get the performance that we're getting there. So yeah, 4 of us running the money. First fund was set up in effectively in January 2006. And we have an unlisted fund which we set up in April 2011. So I think importantly for people looking at a fund such as ours, there's 17 years of data now to assess how we've actually gone over a reasonable period of time.
I was going to say, and over that 17 years, there has been solid outperformance of the market. And I probably want to dive into maybe talking about the process that you guys use that's generated that outperformance over some time. And I think you just mentioned there, ego was something that you guys all have, which is pretty much a characteristic, I think, of a lot of people in fund management. But I think the other thing is trying to manage that ego, right? And the market can make all of us very humble. So I'd be interested to dig into a few of those things in a little bit. But firstly, I just wanted to ask you maybe views on the Aussie market as it stands right now. We're recording this on Thursday, the 20th of July. The Aussie market has pretty much gone sideways for 2 years, the ASX 200. A lot of volatility within that sideways movement. So a lot of risk and not a lot of return for that risk. And I note that one of the sayings that you have in your written pieces are the price you pay for a seat at the table in the market is volatility. So we are getting plenty of that volatility at the moment. What's your view? I mean, we've just had the sharpest rate rise in a generation. Are you seeing the market as cheap at the moment? Are you seeing it as expensive? Are you neutral? What's your view?
Oh, look, very clearly the market's not cheap. We look at the equity risk premium and we're, at sort of multi-decade lows. So you can sort of see that, when we were writing extensively 2 or 3 years ago, one of the main themes that just kept recurring week after week was the fact that you've got interest rates at, 0.25 or 0.5, and you've got bank, dividend yields at sort of 5.5%, 6% fully franked gross up to 8, 9%. There was a very clear case for why you should be in bank shares as opposed to bank deposits. I think that's completely inverted now. I think it's turned on its head. When you can get 6% in corporate bonds, or 4.5 to 5% in sort of term deposits with a big four bank, I don't think it makes sense, the current risk premium that you're getting from equities. So I think very clearly the market is not cheap, and I think that what we're seeing at the moment is a dichotomy or a digression between your technical indicators or your sentiment and your fundamentals. And I think that technicals continue to improve and fundamentals continue to deteriorate. You mentioned monetary policy, and it's well documented. Monetary policy is a laggard policy. There is a duration of time where before it starts to bite. And I think two things have accentuated that in this current cycle. One is the TFF, the Term Funding Facility by the RBA. That's $180 to $200 billion worth of fixed rate loans that otherwise wouldn't have been written that are now starting to roll off. As a simple example, one of the guys in our team, his mortgage rolled off at 2% and his gone from 2 to 7. That has to bite. So I think that this next 18 months, as these fixed rates roll over, I think that's the first thing. I think the second thing, Greg, is that we also saw a real COVID buffer built up. So people were unable to travel, they were unable to spend it as they normally would, and they were very worried. So what did? They saved more, and the savings rate in Australia went over 20% briefly, which is extraordinary. It takes time for these buffers to burn through, and I think we're getting to the point into that now. I don't think we have felt the impact of monetary policy yet. I think we're about to feel the impact of monetary policy. So I think that's the first thing about the Australian market. The other thing, though, that we are worried about is, because we do use technicals as part of our process, is that the longer we see this market track sideways without a serious correction, surprising in our view, the less likely it is that we will actually see a serious correction, because the closer we are to the earnings recovery, there's no doubt that corporates have to see earnings decline. And we're seeing that, a few of the early companies in the confession season starting to put their numbers out in the marketplace now. So we're starting to see the first signs of that. But earnings have to decline, in aggregate. But if the market, finally has that recognition and, finally starts to react to that, when we were in sight of the earnings recovery, they'll look through the earnings valley to the other side, and they'll see that, the Feds and the RBA is already dropping rates. They'll see that corporate earnings have bottomed and starting to pick up. We may not see, a serious price correction. And this is always the part that we talk a lot about. The market is part art, part science. It was 100% science, and scientists and mathematicians would be the wealthiest people in the world. But it's part art, part science. The science part is we know that corporate earnings have to decline. The art part is we don't know how much that's been factored in to what investors are thinking. We have some insights, For example, we're seeing a very high level of cash weightings across the spectrum, more so with institutional and professional investors and retail investors. But nonetheless, we're seeing a high level of short positions, which are starting to unwind now as they're getting covered. So these are the two things that we sort of wrestle with, and our viewpoint has to be flexible. We've been sitting overweight cash for the best part of 12 months, and it's just been some really good alpha, some really good bottom-up stock selection that's enabled us to continue to outperform. But we know that over the cycle, you can't outperform if you get the beta question wrong. If you get the market weighting question wrong, eventually it'll catch up with you. And so we've done a lot of work around we're sitting on 40% cash, sitting on 33 at the moment. What does it look like? What's a scenario we start to deploy more of that capital?
And what is that scenario? Or is that an ongoing question?
It's daily. It's a daily question, sometimes intraday. Look, I think you've got to be flexible. You've got to understand that the fundamentals have deteriorated at the same time as the market's become more expensive in simplistic terms. So you have to understand that one of those two things has to give. Now, what we'd like to see is July is always a strong month. August, September statistically are the two weakest months together on the ASX. I think if we got to the end of September and we hadn't seen this market start to roll over, we haven't seen a tangible change in sentiment. We started to see some signs of this in June, and the market's bounced back pretty strongly again now. But we haven't seen tangible signs this market's rolling over. Then heading to October, we will be forced to deploy capital.
I guess that divergence between fundamentals and technicals is way more apparent in the US at the moment. You're just seeing S&P 500, NASDAQ going up relentlessly, all the while the fundamental data that's coming out, while not disastrous, it's pointing to a slowing US economy. So how, and the fact that the Aussie market hasn't really followed that path this year so much, I think we peaked probably back in January and we're off those highs. So how much do you think we are still susceptible to a change in sentiment in the US? And when I talk about sentiment, one of the things that we often do on this podcast each week is show the CNN Fear and Greed Index. And for the past month, over a month, it's been in extreme greed territory, relentlessly up high. Investor sentiment is starting to turn around. Just recently, fund managers are now starting to talk about, we think there's a good chance of a soft landing or a no landing. So this sentiment is really starting to grab onto the idea that because the market's going up, I need to change my narrative because the market must be right. So I'm just wondering what your thoughts are on the US market and how that might flow through to the Aussie market if it does turn back down.
Yeah, firstly, you raise a really good point there. As managers, we need conviction in our beliefs, but we've got to avoid fixation. And conviction's a good thing. Fixation's a very dangerous thing. So, we have to acknowledge that we could be wrong not wrong in terms of corporate earnings. That's pretty clear cut. I think we'll be right in that regard, but wrong in terms of how the market reacts to that. And I think again that's where we are. One of the things we're probably jumping forward slightly, but one of the things that's been part of our success is that we are genuinely style agnostic. We see 5 investment styles, and 2 of them being growth and technical analysis. We genuinely try and employ technical analysis into our thinking. It's not going to generate a buy or sell signal, but it's going to help us to fine-tune entry and exit points. It's going to help us to try and work out, where the bulk of the sentiment is heading. So in that regard, we have to seriously accept that sentiment may be different to what we think it should be or to what we think it is. We've got to keep an open mind in that regard. Getting back to the question about the US, look, the old adage, the US catches a cold, the US sneezes and we catch a cold. I think that still applies, particularly in down markets when, fear and panic are stronger emotions than greed. So I think in that regard, I think if you look at why has the US recovered the way it has, it's very well documented. You've got the 7 mega cap tech stocks, and they have continued to see reasonable earnings growth. And I think, when you look at the initial narrative was when interest rates started to go up, the narrative was, hang on a tick, that's bad for long duration growth assets because when you bring back when you work out the current NPV of discounted cash flows 10 years out, when your discount rate rises, that reduces the value in today's dollar terms. So the initial thinking was that's bad for tech stocks. I think then the market very quickly evolved and said, well, it's bad for spec tech, i.e. companies that don't have earnings now and earnings is long dated. But for real tech, it's actually really good because in the environment we're heading into, it increased the uncertainty of earnings. And the companies that have genuine earnings certainty and earnings growth are those big cap mega tech stocks. And so I think it changed the whole narrative very quickly. So the Nasdaq, pull back and then recover quite aggressively. So I do think that the US is very much different in terms of the companies that it has there, but also do think that at some point we've seen a massive underperformance of commodities. Some of the measures that we look at show that commodities are trading from here need to increase 4 times versus where equities are sitting at on a historical perspective. So these are things we sort of throw into the mix there. I do think if the American market has a pullback, it'll impact our market. It can't help but. And it explains also why we haven't risen as yet with it, and also because the nuances of our market. I mean, we're basically a market made up of financials and materials, and so you've got to look very closely at those two sort of sectors.
Yeah, the lack of tech is obviously holding back our market relative to the US. And I think just your comment on commodities there, we spoke earlier about the deterioration in the economic fundamentals, that commodities have certainly reacted to that deterioration. You see oil prices off 50% from their peak, and you can run through a number of industrial commodities that are all well off their highs from 2022. We didn't point out earlier that you guys are Perth-based, so you're obviously quite close to the action in commodities. So maybe we can talk a little bit about commodities, where you see the opportunities, what commodities you like, what you are avoiding, and maybe just a bit of a comment on China, given that the supposed strong reopening theme from China hasn't quite played out this year.
Yeah, I mean, even though we're Perth-based, quite often we don't have any commodity exposure because we really are agnostic in terms of what sectors we look at. At the moment, we're in a very unusual place. I think it's the first time in 17 years where 6 of our top 10 companies happen to be in resources, and that's more of an indication of where we don't want to be as opposed to where we do want to be. Most of the sectors in the ASX at the moment we don't want to be in, based on our macro overview of where this market goes over the next little while. And so we're really struggling to find sectors that we actually think it makes sense to be invested now. We normally have 55 to 65 stocks in the portfolio, so we're very risk averse and very diverse. At the moment, we're sort of running at just around about mid 40s, which is again the lowest we've been in almost a decade there. So, you look at that and you say, well, what resource stocks are we in? Surprisingly, or maybe not surprisingly, it's really just EV facing commodities. We don't want to be in companies that have exposure to bulks and energy at the moment. And I'll step through that when we talk about China. But on the EV facing, we really believe that even if the recession, even if we have a hard landing, and I'm not saying that's not our base case, but if we were to have a hard landing over the next little while, next 12, 24 months, EV facing commodities would still, because of the level of momentum and the low base they're coming off, we would still see growth there. Clearly, we 4 of our top 10 stocks in the lithium space, and 2 of our top 10 stocks are in the copper space. So, between lithium and copper, and we don't really see any other EV facing metal that we have confidence in. Graphite, we certainly don't. Notwithstanding, we're doing some work on Cerro at the moment. We don't have a lot of confidence in some of the rare earths and so forth, because the markets are so thin and opaque. And nickel's an interesting one. We're probably neutral on nickel. We think of the right opportunity, we would play it, but there's not many nickel opportunities on the Aussie market. None of them stack up on valuation grounds that we can make work, at least.
So what's I was just going to ask on the EV theme front. It is a reasonably well-known theme and a reasonably well played theme. What makes you confident that has some legs in terms of an investment theme? Is it the lack of supply that's driving the driving the growth in those stocks?
It's a really good question because, and as your podcast alludes to in its title, we don't want to be in the warmth of the herd, right? We don't want to be right in that spot where everyone's feeling comfortable and we're all, encouraging each other and so forth. We generally
Everyone knows that everyone knows that EVs are
100%.
the next thing, right?
But I think there's two things at EVs. Firstly, on the supply side, absolutely. We've seen fiscal discipline in the majors like we haven't seen in any other cycle. So we haven't seen them rush to bring on new supply ahead of the curve or, spend lots of capital on exploration and the like. We've seen a lot of discipline, returns to shareholders being rated above everything else, and the like there. So I think on the supply side, there's going to be some issues there, and it's well documented in copper. I do think that in the fullness of time, lithium will actually be oversupplied. I don't think it's not rare, and we're not talking large quantities. It's required in the same light as we are, for example, copper. So I think in the fullness of time, I think we're just, because we're in the infancy of that market. You always get that in new markets where you get the supply and demand imbalance and causes massive gyrations in the price. But that'll peter out over time and it'll get back to the cost curve. It'll probably sit somewhere maybe 5 or 10% above your bottom quartile or the top quartile of the cost curve. So that's in terms of those particular commodities. But when we look at other commodities, we don't have the confidence right now that it makes sense to be stepping into the marketplace. And so even though that you've got this strong theme and the herd's running in this direction, because of that supply side and then the demand side, which I haven't really touched on yet, because of the demand supply side, we still have that confidence. On the demand side, we do think that this is a generational change. We think that we're coming off such a low base and that we need to see such a large increase, not just in EVs, but in the electrification thematic, full stop, the decarbonisation, two sides of the same coin there.
Yep.
It is going to be such a large theme, and it's going to take such a long period of time to play out, probably 3 to 4 decades. And we're in that first sort of 5 or so years of a 3 to 4 decade theme. You can get it very wrong in the short term, but that tidal wave is going to carry you forward over time. We saw that the iron ore, a good example. If you had to have invested in 2004 in an iron ore stock, if you had seen the tsunami coming from Chinese demand for steel, it didn't really matter what iron ore stock you invested in.
Yep.
You made between 100% and probably 2,000% on your capital or more. Right? That was such a large theme. I think this is an even larger theme, and it's probably one of the first genuine themes we've seen since the iron ore one, especially in commodities.
And you've seen a bit of that play out in the lithium space. I think it was the first wave happened around 2016, 17. There was massive rises, big bear market over the next couple of years. Then it's gone again. So I guess that's the type of thing you're talking about there, is that you're going to get the cyclical downturns as more supply comes on, but the growth of demand will absorb that supply over time, and those cycles will pick up. I guess that's what you're alluding to there, right?
Yeah, exactly that. I mean, if you look at, say, iron ore, you bring on a new 40 million tonne per annum mine, and it's like, okay, it's sort of 5% of less than 5% of seaborne iron ore production. But you bring on a new lithium mine, and it can materially, it might be 30% of current spodumene demand. So you get these big imbalances, and we saw that with the lithium winter when everyone thought the whole shooting match was over, because you had some mines come to, they were mainly hard rock. People weren't expecting the hard rock spodumene in WA to get up and running as quickly as it did. When that hit the market, the market was still growing at this level. And that was a big wad coming on. WA is producing round about 50% of the world's lithium through hard rock at the moment, which is extraordinary. But that demand will get soaked up very quickly, and then it's going to be such a larger market as a base that each subsequent mine and each subsequent, battery factory coming on is going to have less of an impact on the price. So you get these gyrations. Now, this is the thing that's keeping us away from rare earths. We don't think rare earths will ever be a very big market. In fact, I don't think anyone's saying it'll ever be a very big market. And same as graphite. When Syrah came into production, I think it produced, I can't remember the exact numbers, but it was a ridiculously high percentage of the world's existing graphite suddenly coming on one new mine.
Yep.
And I don't think they've run it at full production, for 12 months as yet. And they've got on care and maintenance at the moment again because they've oversupplied the world's graphite.
Yep.
That's the issue we have with rare earths. They're too opaque and those markets are too shallow. So lithium makes sense over the short to medium term. Copper makes sense to us over the short, medium, and long term.
You said you were avoiding energy, but I do note you have beach energy in the portfolio. I've also got beach in the portfolio. It's been a long-term value play, and it's been cheap for many years. Is that more based on the fact that it's got this Waitsia project coming into view that's going to add considerable value if they get the development right and all those sorts of things that's behind that?
Yeah, I mean, it's a couple of things, but you're spot on. It's a bottom up opportunity. We can put things in the portfolio from based on a top down theme, or it can be a bottom up based on growth prospects, or valuation prospects, or even quality prospects, and that's really a bottom up driven opportunity there. We think that there's still. We've almost had the perfect storm of bad news flow for gas producers, domestic producers in this country. And we think that that's now abating. I think a bit of I'm looking here politely. I think the government's starting to realise that the best way to alleviate high prices is high prices. Right, high prices will create more capital going into something, which will create greater supply, and in fullness of time, greater supply will reduce the price. Now, we're not in a government that is. I think Mr. Chalmers is not showing himself to be particularly learned on capitalist economics, but I think even he'll realise.
Nor is Chris Bowen.
That's right,
former treasurer.
Yeah, so I think what we're going to see at some point though is that there's this realisation here that you can't keep making it more onerous to produce domestic gas and expect greater supply. Like it's just nonsensical. So I think we're through the worst of that argument. I think a lot of the reservation chatter and price caps and so forth. There's still some work to be done, but we're through the worst. And I think that Beach and Santos are very well positioned, and we've got Santos as a holding as well, are very well positioned to capitalise on that recovery in the domestic gas price and the recovery in the sentiment around the domestic gas supply. Woodside, we went very hard on our portfolio in the low 20s, and we were 100% out of that now. And we don't understand the case for Woodside. In our numbers, we've got at least 2, possibly 3 years of EPS declines. So on top of the fact that it's on the nose from an ESG perspective, we've got EPS declines. We've got some risks around project approvals. You've got some risks around execution. And the commodity price has been battered. It doesn't make sense to us at these prices. We would need to see oil through $100 a US a barrel before we would sort of dust off the file on Woodside.
Yeah, I think Woodside's more of a macro play on the oil price. I would say, given that I have Santos and Woodside as well in the portfolio, Woodside, for me, it's held up remarkably well, given that oil prices have fallen 50%, and I think that's a tick for it, for sure.
Having said that, it's interesting because when oil prices bounced aggressively, Woodside just kept sitting there 21.22, 21.22, and it wasn't something triggered. I think the same we'll see in reverse. At some point, there'll be some factor that will trigger that derailment. Although, again, when you look at, if you want to play that theme, as you say, how do you play it now? BHPP has been absorbed by Woodside.
Yep.
You've really got two options if you're a blue chip investor. It's Woodside and Santos. So You're right. If the thematic starts to get some airtime, then it will recover. Then it'll at least hold its own and possibly recover from here.
And if the charts tell you to get out, you get out. That's the way I look at it.
Yep. Indeed. Yeah. Yep.
The other thing I was going to ask, just on energy policy, you touched on it there before, and I see no reason to be polite when it comes to the way our politicians are looking at energy policy in Australia. And I think one of the big risks that we face as a country in this energy transition is moving towards a higher cost of energy. And throughout history, that's never happened before. Every form of energy discovery has lowered the cost of energy, which has gone on to create wealth in forms of freeing up resources for other things. Yet this energy transition is going to impose additional costs on us, whether that's through electricity, whether it's through the safeguard mechanism that is being put on a lot of our larger industrial companies. Just wondering how you guys see that as a longer term theme, whether you discuss it or whether it doesn't really play into your stock picking process.
It doesn't overly play into it because, we're focused more, our time horizon generally is, 12 to 24 months. And whilst we look at the big themes, because we want to make sure that if we, get it wrong over 12, 24 months, what does it look like? So we do give some thought to it, but we don't spend a lot of our time thinking through those things. I would say though that, I remember, just a short story, I remember probably the best part of 15 years ago, talking to one of the preeminent experts in solar, in wind, it's actually wind generation in Australia, and he said to me at that time that that all the energy produced from this particular wind turbine at that stage didn't even cover the amount of energy that went into producing the wind turbine itself. Now we've come a long way, and I've got confidence. You look at the pricing, of your PV, your photovoltaic cells, and how we've gone down that curve. It's been an enormous cost curve. I think the final piece of the puzzle, from little we know, is really around the battery technology. I think that once you get that battery technology where it needs to be, and we're still clearly some way off that, I think then we would hold hope that you'd actually be producing power at a cheaper cost than traditional fossil fuels. I think that, you've got, when you look at wind, especially in this country, you've got land, you've got wind, I think we'll be well and truly producing at costs that are a fraction of the kilowatt hour cost you're paying now for traditional coal fire, and even certain coal fires are cheapest, but gas especially.
Let's turn to the fund, and I mentioned at the start there's been long-term outperformance, and the effect of compounding. Even a small percentage of outperformance over a long period of time can result in a huge, different outcome in terms of your financials from investing in that. Can we talk a little bit about the process that generates that outperformance? I think, I'm not sure who said it, but I remember reading somewhere that someone said there is no point trying to manage money in the market if you can't beat the market, because otherwise you can just sit in an index fund. So you guys obviously been successful in that, and that all comes down to process. So I wouldn't mind getting a few insights into the Katana process that's generated that outperformance.
Yeah, sure. I mean, firstly, just to recap, I think, the power of compounding is extraordinary. Over the 17 years, if you invested in the top ETF, we always get asked this question, why don't I just put my money in an ETF? If you invested in the top ETF on the ASX, the STW.AXW, you'd have 192% return net of all fees, and that's based on the index return of 204%. If you invested in the same time frame in a fund, that got an extra 2.8% per annum net. So 2.8% per annum net doesn't sound much, but you've got 2.8% per annum net over the index, then the returns would be 403%, which is what we've got in Katana net of all fees. So that 2.8%, but compounding over 17 years, is the difference between 192% and 403%. So you're absolutely spot on. People don't realize the power of compounding. We all think we do, and we all talk about it, but it is extraordinary, and it's a hockey stick. The longer you're in, the more the compounding takes off. Like I love telling people Warren Buffett's earned 99% of his capital after the age of 55. It's not because he's a better investor now, he's got such a large capital base.
Yep.
So in terms of how we've gone about it, one of the things that gives us confidence, and I'll be honest, we are nervous investors. We don't ever sit here going, well, that was a great month, let's just take it easy. I mean, we are always constantly worried about what can go wrong, where we're going to make our next dollar of alpha. We're constantly thinking in those terms. I mean, I'd hate to be myself in some regards, because I'm always constantly worried about, what's next and how we're going to continue to outperform. But one thing that gives us a little bit of confidence is that over every time frame, we've had our outperformance of the index. So it's not just over 12 months or over, since inception. We haven't back-ended our numbers with some big returns 17 years ago or fronted our numbers with some big returns now. There's that constancy of returns over every time frame. And one of the things I think that's due to was a couple of things. Firstly is that we've removed any artificial constraints. So we've tried to say we love constraints, we love process, we have a lot of constraints, a lot of process, but where they add value. So where we see things that are artificial constraints, we've taken them out. Now, it's also worked against us because a lot of asset allocators can't get their minds around us because we've taken a lot of these constraints out, and we understand that and we respect that. But simple examples are, I'm a resources fund or not, I'm a non-resources fund. I'm a big cap fund or I'm a small cap fund. I'm a value investor or I'm a growth investor. All these things don't add value to just plain old performance. They help pigeonhole you and help a variety of different asset allocators put us in the right mix, but they don't actually add to our long-term performance. And another big one is in terms of thinking in terms of the index, right? I'll put this to you, Greg, which just sounds ludicrous. If you don't like the banking sector, but you don't dislike it, so you don't like it, but you don't dislike it, you'd have 25% of your money in the index.
It's crazy.
Because if the banking sector makes up 25%, you don't like it, but you don't dislike it, that means you're neutral. So your starting weight is 25%, and then you dial it up and down depending on how you're thinking. So if we don't like something, but we don't dislike it, it's zero weighting, right? And then we'll dial it up where we think that it can add genuine alpha to our performance. Now, obviously, we need to benchmark our numbers against the index so people can see how we're performing, and obviously, we need to market in those terms. But we don't, as much as possible, we try and avoid thinking those terms. We don't say to ourselves, right, banks are 25%, we better have some bank exposure. We start at a zero weighting, and where the case is there, like at the moment, and in the last few days it's hurt us, but I think we'll be okay over time. In the last, we have zero weighting to the big four banks. Our weighting to big four banks has been between 0 and 35% over the last 17 years. And at the moment, we're at 0% exposure. So that's the first thing, is I think we've reduced the artificial constraints. The second thing is that we've got really good process. Like, we've been managing money for 30 years and 17 years together. Brad and myself, and Giordano's been in his 13th year. Hendricks and Uber, he's in his 4th year with us, and he'll be here with us for the next 15 years, or else we'll put a contract out on him. But we've got some really good process. Like, we've got a 155-point checklist that we can optionally go through if we're concerned about how company's performing, and that's just 155 different ways we've lost money in the past 30 years. And each time we lose money, we document that and work out how we're going to try and avoid it next time. We've got 11 key criteria. We've got a very well-defined process about how a stock makes it into the portfolio, what weighting it gets, how we manage our stop losses. If you said to me, if you're interviewing a manager, said what's the most important thing about how you manage your money, I would say it's how they manage their losses.
Yep.
Like, winners are going to take care of themselves, but how you manage the stocks that are underperforming in your portfolio, that'll determine whether or not you'll outperform index long term or not. And then the third thing I think is really the people. Like, I did mention at the outset we have got big egos, and I'm not going to shy away from that. We have got big egos, but and big personalities. But that drives us. But at the same time, we are humble enough to realise that we're going to get things wrong. We do get things wrong, and unless you have humility, you're not going to be able to recognise it. You're not going to be able to pivot. And I think you also need, character and integrity. If you don't have those things, then it's a question of time before you're going to blow up the portfolio or destroy other people's wealth. And then probably the final thing is over 20% of the money that we manage is our own money. And we started the journey in this fund, along with everyone else in 2006, and we add money every quarter to our funds. Now, we are highly incentivized to get the best returns possible on a risk-adjusted basis. There's a lot of things that I would contemplate doing on my personal play account that I'd never even dream about doing in the Katana funds. We are very risk-averse. We're not going to run these funds for a big performance fee and risk things. We're really about making sure that we preserve our capital and get the best risk-adjusted return we can, given our capital is here tomorrow.
I noticed one thing that you wrote in one of your reports. It's only a small thing, but very powerful, is know thyself when it comes to how to handle your emotions in the market. And I think I first saw that saying, even though it's an ancient Greek or Egyptian bit of wisdom, I first saw that in a book called The Money Game, and it was written by a guy called Adam Smith. That was his pseudonym. And he also wrote this really interesting piece that I think it's very powerful. And it says, if you don't know who you are, the market is a, it was something along the lines, if you don't know who you are, the market is a place where you will find that out. So just wondering what sort of experiences you've had over the 17 years. It's really sort of made that statement quite stark to you, and thought, crap, I'm managing other people's money here. This is serious, and am I up for the challenge?
Yeah, you're spot on. It's really humbling. Like I had to come to realization, and it took me probably the best part of a decade and a half to realize it. Well, not to face up to it. The fact that I am actually wired in a way which fundamentally is flawed in terms of managing money. And I probably should step through that so that I don't scare away all our existing investors there, Greg. But the old four human emotions, fear, greed, ignorance, and hope. Those four primeval emotions, which are written about so beautifully in Reminiscence of a Stock Operator, which is probably my all-time favorite investment book.
Yep.
Those, how you respond to those emotions will go a long way to understanding yourself and understanding how you will be successful otherwise. As a simple example, when stocks go up, fear, greed, ignorance, and hope in and of themselves are not about emotions. It's that those emotions come to the fore at the wrong time. For example, if a stock goes up, the appropriate response should be to have hope that the stock will go higher, right? So that would be, if you're wired in a way where your natural emotional response is, stock's gone up, I hope it's going to go higher, you'll be a successful investor / trader. If your natural wiring, which is mine, is that if the stock goes up, I fear that I will lose part of my profit if I don't sell, right? That is a flawed wiring. Another simple example is when a stock drops, a flawed wiring would be to have hope in that situation. So if you hope you recover your money, that's the way you're naturally wired, and you can only do it by experiencing it.
Yep.
And that's a flawed behavioural response. If a stock drops and you fear you'll lose more, therefore you stop it out, that's a great behavioural response. And so it's been a real journey. We're working with my brother Giuliano. I've come to realise that he is wired perfectly how a trader should be wired. Like, his natural emotional responses are in line with how they should be. My natural emotional responses are diametrically opposed to what they should be. So it's taken a long time to understand that, and then to put in place safeguards to firstly, recognise, to know thyself. The first step in the 12-step help program is to admit you've got a problem, to understand the problem, and then to recognise that. So, I have to put in place things like, I have to consciously sit above my emotional response and understand what I should do. We've had to put in place group think and group process. So as a team, we manage all our losses as a team through a formal process, which removes the person that's championed that stock in the portfolio. So there's just a couple of ways. So
that effectively runs checks and balances on the personality then, right?
Correct, yeah.
The other thing I was going to ask is just on you mentioned right at the start, the equity risk premium in the Aussie market. And really, for those who might not be familiar with that term, the equity risk premium is the additional return over and above you get of a risk-free asset to invest in equities. So the extension of that question is what, and I don't know if this is how you guys go about your valuation process, but what discount rate are you looking at, or a required rate of return when you're investing equity? So if we look at the Aussie 10-year bond yield as a proxy for a risk-free rate, it's around about 4% at the moment. We chuck a 5% equity risk premium on top of that. We're looking at a discount rate of around about 9%. Over time, I've used 8%, and I find that generally gets me in at a pretty good long-term price. Just wondering what you guys use if you do use that type of valuation approach.
Yeah, well, we do, and I think you're more or less around the mark there. I think that the bigger question we try and come back to, for us at least, is we just keep it simple. We say, if you're an investor, if you're a mum and dad trying to live off your income, trying to fund your retirement, trying to save up for an asset, where does it make sense for you to have your money in the bank, and where does it make sense for you to have your money in bank stocks, as an example, and dividend yielding stocks? And I think there has to be, at least sort of 200 to 300 basis points differential to justify the risk that you're going to take on. So, as a simple example, the Aussie rate's 4.1 at the moment, so which is risk free. We're getting now, we're seeing, I think it's probably getting towards the end of the cycle, but the big four banks or some of the big banks have been fighting for deposits to replace the TFF. So, we've been getting 4.5%+ on NAB deposits, right? Just for our spare cash in Katana.
Yeah, right.
Which is, we can get slightly higher than some of the regional banks and other players, but when you can get that risk-free pretty much, that's a great return. Now, if you're saying to me I get 4.5% knowing with 100% certainty that in 90 days' time I've got my capital back, or I can get maybe 5.5%, 6% with some franking credits, mind you, but then with uncertainty around what my capital looks like in 90 days' time, to us, it doesn't pass the pub test, it doesn't pass a common sense test. Every day of the week, you're going to say, well, I've got 4.5% with certainty. That makes sense to me. I don't think the market's really adjusted. Like, I've been surprised at how we haven't seen a real adjustment in terms of, at institution level. Yes, we have. We've seen, bond flows at strong levels, and I think with bonds now starting to roll over, or yields starting to peak or roll over, you could see some bond capital growth as well, which might make it more attractive. But I have been surprised that the equity market is this strong with the risk-free rate so high.
Well, I'll give you one example. A couple of weeks ago, or maybe a couple of months ago, we did on this podcast, I showed the difference between the valuation for Commonwealth Bank and JPMorgan. And Commonwealth Bank was trading at a price to book of about 2.2 times, and JPMorgan at the time was about 1.6 times. And JPMorgan, I think their return on equity projections were the same. So their profitability was the same, except you're paying way up here for Commonwealth Bank, and you're getting a reasonably good price for JPMorgan, which is, one of the preeminent banks in the world. Obviously, slightly different business models, but that just really showed the difference between the perception of the US banking system versus how investors are looking at probably the best and most solid bank in the ASX. Last couple of questions. The name of the podcast is What's Not Priced In. So I wouldn't mind getting your take on, I mean, we've covered a lot of what's not priced in anyway throughout this conversation, but maybe just a bit more explicitly, if there's any one particular area that you think is an opportunity or a threat, what's not priced in from Katana's point of view?
I think what's not priced in is 3 or 4 things, but I think there's still things that we're too early on. So we've done, I think if you look at consumer discretionary / retail, I think now that some of them have been overly discounted, but it is still the wrong time. It's still too early to move. I think REITs haven't been priced in terms of what we're going to see on the downside yet, and that'll create the opportunity post that. I think you're starting to see funds that are getting gated. They're limiting returns. We've seen a couple of the last week now. A couple of big funds come out and either restrict distributions or to 25% of flows or just to actual earnings. So we're starting to see some things happen there. So I think that's another one there which I don't think is fully priced in as yet. Non-banks is a great example of something where we're seeing non-banks that are being priced for failure. A simple example is Pepper Money. We've done an enormous amount of work, and it was a 289 float, it's trading $1.30 odds a day. It's 5 times earnings, but people have priced it for failure. And if you actually do the work, they've had a 21% CAGR for 8 years, compound annual growth rate of 21% per annum. They've been around for 22 years operating. Great opportunity as the banks jump out of a lot of this areas, like, for example, banks jumping out of auto finance and the like, creating super opportunities for Pepper and Liberty and others in that space. So, I think that the non-bank sector, I think that people haven't priced in just how important that is and how much money they're generating. And I think in the fullness of time, but again, if you look at it and you say, well, would you go hard on Pepper today? No, I wouldn't. We've built a little bit of a position because we don't want to miss it. We know we're going a bit early, and we often go a little bit early on the first portion of what we buy. But there'll be at some stage you'll see Pepper in our top 10 holdings. I've got no doubt about that. So I think that hasn't been priced in how much value is there. And then I think also, we talked a bit about China, but I think there'll be a time to go hard on bulks. So, iron ore and coal and the like, and there'll be and LNG, and there'll be time to go hard on the LNG energy complex. But I think what has to happen there yet is, and people need to understand a bit more about the China theme. We're getting closer now. We didn't really buy the China reopening story, but we are getting close now to where the central authorities have to look at some serious stimulus, because it is starting to get at the point where it's bordering on social unrest, and that's the point that they'll be forced to act. Now, I think people need to understand, and we were saying this just recently, that stimulus on infrastructure projects and the like won't have the same effect. It has been that button has been pressed so many times now. They don't need any more housing. There is a very large oversupply of housing. You could argue there's still a need for infrastructure, particularly the electrification of the grid. You could say that there's still a massive need, and that'll be great for copper and so forth. So yes, there's some big energy infrastructure projects which they can still press the button on. But in the scheme of it, if you look at the stimulus package, this next one, which we suspect will be in the next, little while, if not sooner, we would say that it's not going to have the same tangible impact on commodity prices as past ones. And so I think those days are gone. The days of a big Chinese stimulus package driving iron ore price, it'll drive a little bit, and it'll have a bit of a sugar hit from sentiment, but it's not going to have the same impact. They've got to work on how they, what other buttons they can press now, and obviously in the services area and the like, to get a meaningful recovery. But nonetheless, the bulks will still have a recovery at some point. And I think on the energy complex, I do really still like that. I just think people have dramatically underestimated the pace at which we're going to be able to replace fossil fuels, at the same time that we're spending less and less on exploration and new developments. So I think you could see some really interesting price spikes in crude over the next couple of years. And I think if you're nimble and you can recognise where the signs are lining up, I think you can play those and do really well, because stocks will probably move disproportionately.
And especially if Europe isn't as lucky as it was last winter and has a bit of cold weather, I think that'll be interesting.
Yeah, absolutely.
Romano, last question. Tough one for you. What books or book are you reading at the moment, mate?
Well, I only read two types of books. I read religious and historical religious books, and I read books on the market. So I'm a pretty boring. I don't read any fiction at all. But I've been trying to nut my way through St. John of the Cross, Long Dark Night of the Soul. And if anyone's been able to finish that book, I take my hat off to you. Congratulations. I'm stuck at about 80% of the way through, and it is just very slow going to understand what is actually meant and the application to one's life. So there you go.
And what's the roadblock with finishing it? Is it trying to process it? Is it trying to apply it to a modern world where you're a money manager?
Yeah, all of the above. Just I think the thinking is so different to the way we think about the world today. The embracing of suffering, the embracing of cross, the embracing of complete and total despair, to void oneself of anything that is material and anything that is of importance to one's life, to then find enlightenment. And from a Christian perspective, I think it is so difficult to understand and to understand the applicability to one's life. It's a really tough read, but I'm committed to get through it.
Well, it sounds really interesting, and you make an interesting point in that. For example, the Stoic philosophy was, I think Christianity borrowed a lot from the Stoics, and the culture of the Romans were built around Stoicism, and Victorian England was a very Stoic society. These powerful empires were all built around that embrace of suffering, whereas our society these days is so immersed in materialism and consumerism that that's not even taught anymore. So if you want to find it, you have to find it yourself. And back in the old days, these philosophies were all taught in school. So we could talk for another hour about this, because I find it very interesting with young kids and trying to teach them the right way. But is that something that you try to impart with your kids as well?
Yeah, I mean, absolutely. We run from suffering, right? But suffering is unavoidable. Yet through suffering, if you look back on any period of suffering in your life, it is when you've grown the most. Whether it's as a money manager, like I grew the most as a money manager during the GFC. It was the most difficult period of my life, no doubt. Weeks where we weren't really sleeping. But it was also where we grew the most in terms of our process, where we finally cemented our stop loss process, the understanding of how to manage those situations. We grew in terms of understanding quality of business and the like there. So yeah, suffering is something that we as human beings run from and try and avoid, and I still do today. But if we can, maybe not embrace it, but accept it, when we come through the other side, if we accept suffering for what it's meant to be, we always come out the other side better.
Very true words, and we'll leave it there, mate. Thanks very much for joining us. And
thanks for having us, Greg.
Hopefully catch up again soon.
Yeah, definitely. Cheers.
Thank you.
Thanks for joining What's Not Priced In, your weekly source of unique ideas in the Australian stock market. Now, if you've enjoyed this episode, please show your support by liking and subscribing, and turn those post notifications so you don't miss a thing. And stay tuned for the upcoming episodes as we delve into new topics, new trends, and new stocks. Thanks for your support. Hope to see you next week.